What we are going to learn today is a financial ratio analysis. See, practically your profit and loss account as well as balance sheet are made for the reason. You might have learned it at your lower standard. What are the reasons? So that it is helpful to stakeholders, so that it is helpful to owners, so that it is helpful to outsiders, so that it is helpful to employees. Now the question arises, how just by reading profit and loss account and balance sheet it is helpful to stakeholders? I'll tell you, a company is earning profits of 100 crore rupees. Can anyone tell me whether it is good or bad? Or it is excellent? Rashida?
It is good, but we also need to see what are its liabilities.
Its liabilities? Exactly.
Or its borrowings, maybe.
It's boring. Alright. See, I tell you, if the capital employed, what was the first answer is it, sir, it may be good. But it depends whether it is good or bad. I'll tell you how. Suppose the capital employed, total money invested in this company is say 10,000 crore rupees. Then if you consider this as your return or profits, then it is only 1% of your capital invested. And even fixed deposit gives you a return of 4, 5, 6%. So it is bad as compared to even fixed deposit. So alone, in isolation, 100 crore rupees looks good. It is a big amount of money. For a person who is earning 1 lakh, 2 lakhs rupees, it is big amount of money. But it is not good in this case. Anything which is good, bad, or average, you can determine when it is compared. Say this is compared with capital employed. Return on capital employed. We have done our, we do EBIT divided by capital employed. Instead of EBIT over here, I have taken profit. But understand, we are just understanding how this chapter is important. Say, sales of this company is 1 lakh crore. Then your sales to net profit ratio is only 0.1%. Then this profit is good or bad? It is bad. Why? From every 100 rupees goods sold, you are earning only 1 paisa. You are earning only 1 paisa. So even if the selling price decreases by 1 paisa, you will start earning losses. So 100 crore in isolation, you can never say whether it is good or bad. So we find out answers by comparing two figures, sales with capital employed. What we did? 100 divided by 10,000. What we did? Sales divided by capital employed. And sales divided by, profit divided by capital employed. And profit divided by sales. This is net profit ratio. This is modified R ratio. P divided by sales. What we did? 100 crore divided by 1 lakh. And now it makes some sense. Always a comparative figure makes some sense. This concept we have learned even when we were doing cost of capital. That 100 crore rupees interest might be termed as lower, might be termed as higher. It depends upon what amount you have borrowed. So in that case also we did interest divided by capital multiplied by 100 and found out the cost. So whenever you want to analyze something, I'll give you another example. Say I'm telling you My company is earning a cash profit of 100 crore. Good or bad, you can never say. Except it is compared with some other figure. And that answer is compared with industry standard, or that standard is compared with other companies. Then only you can understand whether it is good or bad. And whenever one number is divided by another number, it is termed as a ratio. What we are going to analyze? Financials of the company. So the chapter name, financial ratio, by which we will be doing analysis of the company, by which only financials, that is, we are not analyzing how quality products they are making. We are just analyzing only finance, that is numerical, that is profit and loss account and balance sheet, that is trading profit and loss account and balance sheet. So this is a concept of financial ratio analysis, and we are going to learn different ratios which are used for different purposes. First, we are going to go to liquidity ratios. Now, what we'll be doing is we will be first logically understanding all the ratios in 1.5 lecture. So today we will be completing some portions of ratio, and tomorrow in next lecture we are going to do other ratios, and then we will move to questions or sums after learning all the ratios. So, which are the ratios? Try to concentrate. First ratios that we are going to learn is liquidity ratio. Whether the liquidity of company is good or bad. Let me take one balance sheet and try to explain you the concept of liquidity ratio. Current assets of a company is 100 crore rupees, 100 crore current assets. Current liability of a company is 80 crore rupees. Whether it is good or bad, first let me explain you what is the meaning of current asset. Current assets are the assets which in a small period of time will be converted into cash. Then only it can be termed as current assets. Fixed asset can be converted into cash in a long period of time, will be termed as fixed asset. So current assets. So in a short period of time, how much money you are going to inflow, or which is already cash, because cash is also a part of current asset. 100 crore. In a short period of time, how much you need to pay? 80 crore. So your cash generation will be able to pay your current liabilities. Your cash generations will be able to pay your current liabilities. And so see what I am writing. It is good liquidity. What does it mean? When creditors comes to me, we will be having sufficient cash to pay off our creditors. That is nothing but we will be having good liquidity. This is nothing but the concept of liquidity ratio. What is liquidity ratio in this case? I will tell you. First that we are going to learn is current assets divided by current liabilities. And this is known as current ratio. And what is current ratio? 100 divided by 80, which is 100 divided by 80 is 1.2. Great. So, any ratio which is greater than 1 is a good current ratio. Any ratio which is greater than 1 is a good current ratio. See the analysis. Any ratio greater than 1. What does it mean? Current asset will be greater than current liability. Then it is good for a company. Alright. See what I am writing is only good liquidity. Suppose this current liability figure is say 150 crores. Can any student help me out in explaining this? 150 crore in current liability, current assets are 100 crore. Drashti, what will happen?
The current assets are not sufficient to pay the liabilities.
The current assets are not sufficient to pay off current liability. In this case, can I write down there is a bad liquidity? Alright, Drashti, you are online. Can you tell me whether this company will be earning less profits, or you cannot say?
We cannot say.
Why?
It may can earn from equity and borrowings, other borrowings also, and it can yield the interest from investments too.
Alright. But why can't you say cash is less, debtors are less, stock is less, and current liability is more?
I can't say.
Alright. I'll give you an exact reason. Say this company is earning 4,000 crore rupees profit current year. Profit will always reflect on asset side of balance sheet. See, profit is an item of liability side. Huh? But liability and assets always matches, matching cost concept or matching concept. So whenever something appears on liability side, it always appears on asset side in form of cash or in form of any other thing. Now, in current year, we have purchased the building worth rupees 3,900 crore. So, more investment is done in fixed asset. So less of the investment is reflected in current asset. So just because your current assets are not capable of paying your current liability, that does not mean that your profits are less. You cannot say anything about the profits. Profits, forget it. You cannot say anything about your profits. But you can say about your liquidity. And so only current ratio is a liquid ratio. Try to understand what will be current ratio. Current asset divided by current liability, which is 100 divided by 150, which will come to 0.67. I told you less than 1 is not a good current ratio as far as liquidity is concerned. Profitability cannot be forecasted. Profitability cannot be analyzed from which ratio? Liquidity ratio. We can analyze only which ratio or only which thing, that is liquidity. So this type of ratios are known as liquid ratio or liquidity ratio. All right. Concentrate. My current asset is 100 crore and current liability is only 10 crore. Hitarth, can you tell me whether this is good situation or bad situation?
Good situation.
See that I am writing good situation. Believe me, it is good situation as far as liquidity is concerned. It is bad situation as far as something else is concerned. I'll explain you, and then we'll be going to very important topic of financial ratio analysis, which is normally asked in theory, but if you understand this concept, this will be very good. As far as liquidity is concerned, there is no problem. Believe me. Why? Whenever your creditors will come to you for payment, you will be always ready with the cash because you are having too much liquidity. Liquidity position is extremely good. Liquidity position is extremely good. There is no doubt about it. All right. But try to concentrate this balance sheet. You know, in 11th standard, you were told on asset side of balance sheet, you write down first item, which is goodwill. And normally you write down last item, which is cash. Then there is fixed asset, then there is investment, then there is debtors, then there is a stock. So this all are fixed assets, this all are current assets. Can anyone tell me the reason why fixed asset or goodwill is written at first point and cash is written at last point, as last point? There are institutions which write down cash first. There are banking, other institutions which write, which in balance sheet will be writing down cash first. But why in normal balance sheet goodwill is written first? Any student, and cash is written last. Come on, you'll try.
Sir, no idea.
Abhishek, try out. Your faculty has told you goodwill should be written first.
No idea.
You are having idea that goodwill should be written first, all of you? Hitashvi?
No, sir, I don't know.
Alright. I'll tell you why goodwill is written first. Try to concentrate. The balance sheet in traditional manner is drafted in such a manner that the thing which gives you highest rate of return is written first. So this goodwill gives you highest rate of return. How? How much money you invest in goodwill? Say a Levi's jeans. The jeans is costing rupees 400 and they are able to sell at 4,000 rupees. See, I make my own jeans, JP. My cost is also rupees 400. My jeans are not sold even at 600 rupees. Why a company named Levi's can sell it jeans at 4,000 rupees? Because of goodwill. How much amount Levi's has invested in their goodwill? Practically nothing. It was done or it was created in due course of time. So investment is minimum, return is maximum. So in this upper side, rate of return will be higher. Alright. Debtors gives you some rate of return, investment in debtors. Try to concentrate what is the meaning of investment in debtors. Because of debtors, your sum of money is stuck in the business. They are not realizing. They are not being liquid. For a short period of time, agreed. But say a goods of credit are sold in 100 rupees and goods of cash are also sold at 100 rupees, then practically debtors is earning 0%. Even if the goods of credit are selling at 100 rupees and cash you are giving 1% discount, then also the rate of return is lower as compared to this. So here the rate of return is lower. 100 rupees invested in cash, cash lying in cash box. You have visited some malls, they are having cash box. This 100 rupees is lying in cash. If they are lying in cash, practically on next day also, after 1 year also, it will give you 0% rate of return. So upper side is giving you higher rate of return, lower side is giving you lower rate of return. And so this sequence. A thing which is giving highest rate of return, we have kept it first. A thing which is giving lowest rate of return, we have kept it last. Or zero rate of return, we have kept it last. Let me ask to one student, Kishan, if you are owner of this company, whether you will prefer that more of your money should lie on upper side or more of your money should lie on lower side? more of your investment should be in upper side of the balance sheet or lower side of the balance sheet?
Upper side.
Upper side, because it is giving you higher rate of return. It is giving you higher profit. Instead of investing or keeping in cash box, try that you purchase a building if you are having money. Then building will be giving you more rate of return as compared to cash. If you purchase a building, you will not have to pay the rent. If you don't pay the rent, your profit will increase. And this is how building will be giving rate of return. But every businessman will try that they will keep more and more amount of money on higher side and less amount of money on lower side. So try to concentrate. Here also there will be higher side fixed asset. Alright. Because more money is invested in current asset, less money will be invested in fixed assets. A total of asset side of balance sheet is 120 crores. Fixed asset is 20 crore. You need to pay a liability in short term only of 10 crore. Why to keep, say this is more of cash balance? Why to keep a cash of 100 crore rupees? Kishan, you are online. Can you suggest this company something? What to do to increase investment on upper side?
Investment in fixed asset.
From current assets. So reduce your stock, reduce your cash, and try to invest that money in fixed asset. This is absolutely all right. See what you should do. Minus, say 90 crore. If it is 90, this will also become 10, this will also become 10. All right. But let me take it 85 and invest 85 over here, so that more money is invested on upper side. More money is invested on upper side. Certain liquidity position, it is comfortable. Say 100 minus 85 will be 15. This is 15 crore, this is 10 crore. So still liquidity position is good. It is not very bad. You will be able to pay your creditors, but your profit will increase because you have invested more on higher side. So let me go to initial example. This is good situation as told by the class. This is good situation as far as liquidity is concerned. But this is bad situation as far as profitability. Profitability is written is concerned. Alright. See what you need to do. If you increase the current ratio, so more amount will be invested in current assets. Your liquidity position will increase or will become good. More current ratio, more better liquidity position. But as more amount is invested in current ratio, your profitability will be lower. So, sir, what we should do? Balance liquidity versus profitability. Because they are inversely related. What does it mean? Liquidity increases, profitability decreases. Liquidity decreases, profitability increases. To increase the profit, let me make a current asset zero. I will invest all amount in fixed asset. It is good or bad? Drashti.
And
Why it is bad?
current ratio will go down.
Exactly. Liquidity position will go down. Profitability will increase. But what about liquidity? If the creditor comes to you, you are not having money. They will file a case of insolvency. Your company will become insolvent. Are you getting it? So, practically, you need to maintain a liquidity also. You need to maintain a profitability also. Now, understand in your module also, in some books also it is given that good liquidity ratio is or good current ratio is 1.33. It is not fixed. There are companies who maintains 1.50. There are companies who maintain 1.33. There are companies who tries to maintain it to 1.10. Depends upon situation. But understand, anything greater than somewhat 1, exactly 1, then also, see, it is possible your debtors might not give money, then you will be having liquidity crunch, your liquidity will be affected. So it is better to keep somewhat more money in current asset as compared to current liability. So if this is 10, let me decide 15 crore. See, I am balancing my liquidity, so I am keeping some extra money for buffer. And I am investing remaining money in fixed assets, so I am increasing my profitability also. So if they are inversely related, either I can increase my liquidity or I can increase my profitability. What a good financial manager will do balance of liquidity versus profitability. All right. So it will keep sufficient liquidity, and remaining portion they'll try to invest in fixed asset which is giving them more rate of return. This is concept of liquidity versus profitability. Normally asked in theory questions, but in theory also you can answer it only if you are conceptually very, very clear. All right. Right now we are, yes.
Your voice is having somewhat disturbance
All right.
in middle.
So this is a concept of liquidity versus profitability. We will maintain sufficient liquidity, but we need to understand that liquid ratio of or current ratio of 10, 100 divided by 10, that is 10. Don't tell it is good for a company, but yes, if someone asks you how is your liquid position, it is good. How is your profitability position? It is bad, because more money is invested in the assets which gives you low rate of return. So your profitability will be affected. We are going to some liquidity ratio. Say I am an interviewer. Let me ask you a question. Darshita. Liquidity ratio higher is very good for a company.
Yes.
As far as which position is concerned,
As far as liquidity is concerned.
and regarding profitability, good or bad?
Bad.
Bad. Then what should company do?
Company should invest in fixed assets.
But what company should do if it is very, very high? It should balance between liquidity and profitability. That does not mean everything should be invested in fixed asset. It should be balancing. Let us learn some liquidity ratios. Number 1, current ratio. Let me write down full name. Current ratio. It is given by current asset divided by current liability. We already have known less than 1, it is bad liquidity position, more than 1, it is good liquidity position, and excess very much is affecting your profitability also. That concept should be also absolutely clear. Number 2, quick ratio. It says current asset minus stock minus prepaid expenses divided by current liability minus bank overdraft minus outstanding expense. But let me right now do only this. Let me write down prepaid. Normally prepaid expenses are ignored, but let me explain you this. Current liabilities minus bank overdraft or CC. CC is cash credit. It is as good as bank overdraft. We are going to learn difference between bank overdraft and CC. All right. Why this ratio try to concentrate? Let me right now remove this and this. Current assets include stock. So what is my numerator? Try to understand. Current assets includes the stock. So what I have done, I have removed stock from my current assets. What we have done? We have removed stock from current asset. Try to understand why sometimes it is good to remove stock from your current assets. See what we are analyzing, current asset divided by current liability. But the stock, if it is slow moving, what is the meaning of slow moving? I purchase it today, it is not sold even in 7 months or 8 months. This is slow moving stock. Fast moving stock, I purchase it in the morning and it is sold in the evening. Say milk bags are fast moving stock. Aeroplane are slow moving stocks. So you need to understand in which business you are. If your stock is very slow moving, you should remove it from current assets. It is no longer your current assets because the cash is not going to realize soon. So you should remove. Say in this type of companies only they evaluate which ratio? Quick ratio. In normal companies they don't evaluate quick ratio. They evaluate which ratio? Current ratio. That is, stock is treated as a part of current asset. But if the stock is realized in a very long period of time, it should not be considered as fixed current assets. And so the stock is removed from current assets. Say this is your asset side of balance sheet. Stock, debtors, cash. Then just the stock is removed. So what we are considering in current assets is only debtors and cash. See what is removed next in numerator. Prepaid expense. At this level, I am not explaining you what are prepaid expenses and why they are written on asset side of balance sheet. But try to concentrate. Your one of the employee comes and says you that, sir, we want 10,000 rupees advance on 31st March. This is prepaid expense. You have already paid it, but the services will not be rendered. So it is your asset because now you will be getting services, but you will not have to pay them. The question is why it should not be considered. Try to concentrate. This 10,000 rupees in a big company is never going to be recovered. Why I tell you? On this year's 31st March, there is one employee who has taken advance of 10,000. On next 31st March, there will be one more employee. This employee will not ask for advance. But say you are having 100 employees. Every year, some or other person will ask for advance. So this is always going to remain on asset side of balance sheet, never going to be recovered. Today you will be giving it back to advance to Mr. X. Mr. X will work for one more month and not ask for salary. Again, another person will ask for salary in advance. And it will remain my prepaid expenditure. It is never going to go out. Whenever you start a business, ask to some businessmen that how many employees ask for prepaid salary or advance salary. Every month there will be one or other person who will always be asking for advance salary. If you are paying them, if your rule says it, believe me, it should be never considered as current assets. Because ultimately money are never going to be recovered. You will say, sir, just 10,000 rupees, that person will not give salary service and we will not have to pay him. Agreed. But next month there will be one more employee who will be asking for advance salary. So which is removed in current asset, prepaid expenditures are also removed in current assets. What is removed in current liabilities? Try to understand. Now we are paying and we are removing it from current liabilities. We are removing bank overdraft or cash credit. Why we are removing, try to concentrate, bank overdraft or cash credit? Say, I am telling you my story. In 2010, one of the bank gave me a bank overdraft of 15 lakhs rupees. Why I treat it as a current assets? Because I need to pay bank overdraft in 1 year. So it is a short-term liability, so it is treated as current liability. But as on today, I took that bank overdraft in 2010. In 2011, it was renewed. Bank told me that you continue with your overdraft because you are a very good customer. In 2012, again, it was renewed. it is still in my bank. I am having still a bank overdraft of 20 lakhs rupees. They have increased the limit. When do you think I have repaid this 15 lakhs? Never. I am regularly paying interest. But I have never repaid this 15 lakhs rupees, which is a concept of bank overdraft. So bank overdraft should not be treated as a short-term liability. It should be normally treated as a long-term liability. And right now we are analyzing short-term position, liquidity position. So bank overdraft is removed from liability side of balance sheet. See, if you are analyzing current ratio, it will not be removed. If you are analyzing quick ratio, it is a modified version of current ratio. All right, this is quick ratio, and this is the formula of quick ratio. See what I am doing right now? I am telling you the formulas, and I am explaining you the formulas. At the end of the day, you will have to mug up all these formulas and apply it in practical questions. So if you have understood it, it will be more better. See, if a person who is knowing why prepaid expenses are reduced or why bank overdraft is reduced is more likely to mug up this formula rather than a person who is just mugging it up. We are going to third ratio, which is absolute cash ratio. Absolute cash ratio, see what it takes in numerator. Now they don't even take any current assets. They take cash plus marketable securities in numerator. So even stock will not be regarded as current assets, even debtors will not be regarded as current assets. What is in your hand? Cash. What are marketable securities? They are as good as cash. Today you are having that security, tomorrow you can convert it into cash. That are marketable securities. So it is as good as cash. It is cash equivalent. We have learned it in cash flow statement. So numerator is cash plus marketable securities, and denominator is current liability. So what it is, it is as good as current ratio. Try to understand, in numerator ultimately you are taking some current assets, but now you are taking only very much liquid current asset, so it is known as absolute cash ratio. Number 4, it is basic difference interval measures. What is this? I tell you. They are quick assets. So this ratio says that you should take quick asset in numerator. Quick asset is this. Current asset minus stock minus prepaid expense. It is nothing but quick asset. So in numerator you should take quick asset. In denominator you should take cash expenses per day. Let me take you to some figures and try to explain you this. My quick asset are say 100 crore. My cash expenses per day is 10 crore rupees. I am doing this interval ratio. It is quick asset divided by cash expense per day. What is quick asset? 100 crore rupees. Cash expense per day is 10 crore rupees. So this is 10. What does this 10 means? Let me give you a hint. This is 10 days. I'm giving you 1 minute. You can just think over it. What does this mean? Interval ratio. How it shows your liquidity position.
That we can bond our expenses for 10 days with this assets.
Exactly. Try to concentrate. This is a corona era. Suppose our business stops. There is no cash inflow. We are still having quick assets. That is a asset without the stock. There are debtors, there is cash balance. We are having quick asset. Then also our business is capable for paying 10 days. What are cash expenses per day? 10 crore. How much money we are having? 100 crore. Or we will be having in a short period of time. So our business can run for 10 days. Even if we are not doing business for 10 days, our cash expenses may run. So we will be able to pay our cash expenditure for next 10 days. This is nothing but what it shows. Our business will run for n numbers of days. In this case, it is 10 days. Even if we are not doing any business, our right now current assets are capable of paying 10 days of our cash expenditure. This is basic defense interval measures. Which was this ratio? Liquidity ratio. And there is one common thing. Higher this ratio, higher is the liquidity position. I am not saying it is good or bad for the company, but higher this ratio, higher is a liquidity position. All right. So this is current quick ratio, absolute cash ratio, basic defense interval ratio. We are going to second categories of ratio, which are capital structure ratio. What are capital structure ratio? Try to concentrate. What is capital structure decision? We are deciding how much debt is to be borrowed, how much equity is to be borrowed. The ratio between debt and equity is known as capital structure. Ratio between debt and equity is known as capital structure. So it will be having some debt, some equity, and we will be understanding capital structure ratio. Before that, let me explain you some definition. We are learning some definitions. One is debt. What is debt? Debentures, bank loan, plus any other loan having fixed interest, except preferentials. So bonds, this will be also covered under debt. Any other security which carries fixed rate of interest. Which company is borrowing? Debentures, borrowing from bank loan, borrowing from any other, having fixed interest will be termed as debt. We already know this. Equity. Equity is equity share capital plus, we have done this n numbers of times, reserves and surplus. Reserves and surplus are funds of equity shareholders. So reserves and surplus will come over here. And equity basically means ownership. So even preference share capital is included. Even what is included? Preference share capital. This is a definition of equity. Try to understand another definition and then we will compare. Equity shareholders fund. What is equity shareholders fund? Equity share capital plus reserves and surplus plus preference share capital? No. Now we are talking about only funds of equity shareholders. Then preference share capital will not be included. So then why it is included in equity? Equity is having a basic meaning of ownership. And preference shareholders are shareholders, and so they are owner of the company. So equity shareholders fund, when you are taking, you should not include preference share capital, but when you are talking about equity, it includes owners, and so owners includes preference share capital. Total funds. Total funds are debt plus equity. Total funds is also termed as capital employed. This we have done n numbers of times in cost of capital, capital structure. Debt plus equity. So it is including everything. Debt, reserves and surplus, preference share capital and equity share capital. Everything is included in capital employed. Total funds will be equal to debt and this equity. So preference share capital is included. We are going to some capital structure ratios. Capital structure ratios. First, debt to total capital. What will be answer? Debt divided by total capital. Suppose this answer is 0.30 or 30%. Can any one student explain me regarding this ratio? The answer is 30%. What does it mean? No one?
In our capital, there is 30% portion of debt.
Then how much is equity?
Equity would be 70.
70% would be equity and 30% is debt. Sir, how this ratio is helpful? We have understood higher the proportion of debt, higher is the risk for the company. So higher this proportion, debt to total capital, higher will be the risk of the company. It just shows how much proportion is debt to total capital. See, total capital includes debt. Huh? So how much of total? It is a debt proportion. Number 2. It is equity to total funds. It will be equity divided by total capital employed. In the example which we took, we have understood it, right? What will be equity to total funds ratio is nothing but equity to equity divided by total capital. In our example, it will be 70% because 30% was this ratio. This will be 70%. Third, debt equity ratio. Now, these ratios are simple because the name itself gives you the answer what you should write down. It is debt divided by equity. In our example, this was 30%. This was 70%. Any student can give me the answer in our example, what will be debt equity ratio? Debt is to equity ratio. Trustee?
3:7.
It will be 3:7. Exactly. And see, all three ratios says the same thing. Huh? Higher the ratio, higher is the risk for the company. But when you are doing this, it is not this. Huh? Only 1 and 3. Higher the ratio, higher is the risk for the company. In second one, higher the ratio, lower is the risk for the company because your equity proportion is higher in second ratio. So it depends upon company to company which ratio they will analyze, but majority of the company analyzes this ratio, which is debt equity ratio. But there are numbers of company who gives even this type of ratio. See, when a company can analyze all three ratios, yes, they can give all three ratios in their financial ratio analysis, and ultimately all three ratios are relevant as far as academics is concerned. Number 4. It is capital gearing ratio. It is debt plus preference share capital divided by equity shareholders fund. See, ultimately it is as good as debt equity ratio, but there is some change. Can anyone explain me what is the change which is happening from debt equity ratio to capital gearing ratio? What exactly is the change happening? Darshita?
Preference share capital is added in debt.
In numerator. And in denominator, have you made any change?
No.
You have made. This is equity.
Yes.
This is
We have
equity
deducted
shareholders
the-
fund. Then
We have deducted preference share capital.
you have deducted preference share capital from denominator and you have added it to numerator. See, what does this ratio shows? We have already understood higher the fixed interest bearing security, higher is the risk. So which are your fixed interest bearing security? Debt. Yes. Preference share capital, even rate of interest is fixed. You will never pay more than what you have decided. So for preference share capital also, it is fixed interest bearing security. So what you have done, in numerator you have written all risky securities, and in denominator you have written non-risky securities. Risk is to non-risk is same as debt equity ratio. But in this case, capital gearing ratio. How much is your equity shareholders capital, and gearing is risk. And so what is your risk proportion to risk-free proportion ratio? It is just adding preference share capital in numerator, that is risky security, and deducting it from non-risky security, treating preference share as a risky security. Is it risky? Yes. It is risky as compared to equity. It is less risky as compared to debt. Alright. But it can be treated as risky, this ratio. Not treated as risky, this ratio. Is it alright? Believe me, majority of the company who analyzes a financial statement always takes out both the ratio. Capital gearing as well as debt equity ratio. Important ratio, capital gearing ratio. Number 5. Fifth is a proprietary ratio. Proprietary ratio is a proprietary funds, equity shareholders funds divided by total assets. Sorry, proprietary ratio includes preferences. It is equity divided by total assets. So let me give you an example. My equity is say 100. And my total of asset side is 200. What is the answer? 0.5 or 50%? What does this mean? Abhishek.
No idea.
Any other student? What does this mean? Equity is on liability side, total assets are on asset side, and the ratio is coming 0.5. Hitat?
So we have double asset than what we are borrowing.
Alright, what we are borrowing from? Equity.
Okay.
Alright, see, I tell you, this is a problem from lower standard, that you, even after understanding how to prepare the balance sheet, you are not knowing something about balance sheet. Balance sheet on asset side and liability side. If you are knowing, liability side is also known as sources of fund, and asset side is also termed as application of fund, or your investments, where you have invested. You have invested 200 rupees in total. So you have borrowed from someone 200 rupees. So it is sources of fund. You will be having equity. You will be having debt. You will be having current liabilities. These are your sources of fund. This is application of fund. Out of 200, 100 is taken out by owners, and other 100 is outside liability. So of all the assets lying in your company, 200 crore rupees assets, 100 crore rupees is taken out by owners, and 100 crore rupees they have taken loan, taken the goods on credit, or from any source they have sourced the fund. This is nothing but the concept. Higher this ratio, higher is the equity proportion, lower is the rest. We have understood. Higher the equity, lower is the rest. So higher this proportion, more and more amount of money are invested by owner. Alright, I tell you that my this ratio is 100%. Now can any student give me an idea, Abhishek? This ratio is 100%.
100% of equity share are forced
Are invested in total asset. So what will be your
total.
outside liability? Zero. Debt will be zero. Current liabilities will be zero. Everything is financed by your equity. There are businesses you say, see, if you'll ask to n numbers of businessmen even in Bhavnagar, they will say we never borrow a loan from bank. So their proprietary ratio is 100%. We borrow only 10% from outside. My proprietary ratio is 90%. All right. This is a concept of proprietary ratios. It shows how much is the ownership of a proprietor. Hence the name proprietary ratio. Next is debt to total assets ratio. 6. Debt to total assets. It is not total capital employed. This again explains the similar type of thing. How much of your total assets is financed by debt? It is debt upon total assets. Number 7. Fixed asset to long-term funds ratio. This is fixed asset divided by long-term funds. See why this ratio, I tell you, it is a deep concept. Whenever there is a long-term borrowing, it is suggested that you invest in long-term assets. Whenever there is a short-term borrowings, it is suggested that you invest in short-term assets. Like if you borrow a term loan, you should purchase a building. If you are taking working capital loan, you can purchase stock. Then the business will run good. Why? Long-term assets will give you return for a long period of time. Long-term repayment you can easily make. Short-term assets gives you return in short period of time, so that you can pay it in a short term. So it will match. So if this ratio is 1, see what is this ratio? Fixed asset to long-term funds. So fixed asset to long-term funds generally should be 1. If long-term funds are 100 and fixed asset is 90, can I say I have invested some long-term funds in current assets? I've invested some long-term funds in current asset, which is not very good. Say this is 100 and this is 90. See what will happen. You have invested some short-term funds in fixed asset. What will happen to short-term funds? You will have to pay it in a short period of time. So practically, if you are going to pay it in short period of time, how you will be getting money in short period of time? Because you have invested that 10 crore or 10 rupees in long-term funds, and long-term funds gives you return in a long period of journey and not in a short period of time. So you cannot sell your building and pay to your creditors. This situation will happen if you do this. So it just shows the balance between fixed asset to long-term funds. And there's a 7th, capital structure ratio. Alright. These are all capital structure ratio. I have explained you. I have tried to explain what does it suggest. But at the end of the day, for getting the marks, you need to mug up these ratios. Third categories of ratios are profitability ratios. Now this will show your profit. First, I'm going fast because this all ratios are very simple. Net profit ratio, net profit divided by sales into 100. If it is 20%, what does it shows? If your sales is 100 rupees, your net profit is 20 rupees. This is what it shows. GP ratio, we have done it in accountancy insurance. GP divided by sales into 100. If it is 30%, what does it mean? If you sell 100 rupees goods, 70% is your direct expenditure and so your 30% is GP. It shows the relationship between GP and sales. Higher the ratio, it is always better profitability. Third, operating profit ratio. Anyone remembers what is operating profit? We have done it in n numbers of places. You might not be getting the relevance, but we have done it. Aman? Yes?
Sir, profit before indirect expenses.
No, it is not an operating profit. Indirect expenses are operating expenditure. We have learned it in n numbers of times. I'll tell you what is operating profit. It is EBIT. Earning before interest and taxes. We were terming it as operating profit. Why? All financial charges are pending. Interest, preference dividend, equity shareholders dividend are pending. So it is termed as operating profit. Again, it is EBIT divided by sales into EBIT divided by sales into 100. Are you getting it? This is nothing but operating profit ratio. What does it shows? Out of sales, how much is your operating profit? Contribution to sales ratio. It is also termed as a PV ratio. Contribution upon sales multiplied by 100. We have done it in leverage. Sales minus variable cost is contribution. So yet fixed expenditure is to be deducted. Again, the concept remains same. PV ratio is nothing but if your sales is 100 and your ratio is 20%, then your contribution is 20% of your sales. That is, your variable cost is 80% of your sales. This is nothing but PV ratio. Concept of profitability ratios. This shows your profitability of the company. Higher this ratios, higher is the profitability of company. All right. What we have done in previous lecture is we have learned three categories of ratio. First category was liquidity ratio. How liquid the company is. How readily available they are making payments to creditors. Number two were capital structure ratio. What is the proportion of debt and equity? What is the proportion of debt to total capital employed? What is proportion of equity to total capital employed? And they were capital structure ratio. And third type of ratios were profitability ratio, which shows you the percentage profit on sales, percentage gross profit on sales, EBIT on sales. That was PV ratio. And we have understood this by profitability ratio. So what we'll be doing today is, today we will be completing the concept of the ratios as far as formulas are concerned. For tomorrow's lecture, you will have to mug up all the formulas, learn all the formulas, understand all the formulas, and then we'll be starting questions of ratio analysis tomorrow. So let us complete all categories of ratio. Fourth category are coverage ratio. So let me first start with the ratio and then I'll explain you by which organization it is used, by which people it is used, coverage ratio. We are talking about first interest coverage ratio. Interest coverage ratio. What is interest coverage ratio? Try to concentrate. EBIT upon your interest is nothing but interest coverage ratio. Try to concentrate over here. EBIT is nothing but operating profit. Say it is 100. Interest is always paid from EBIT. EBIT, you reduce interest from it, right? Say it is 10. This will be 90, which will be EBT. What will be interest coverage ratio? It is 10 divided, 100 divided by 10 will be is equal to 10 times. See, when bank gives you loan, they need to understand whether you are capable of paying your interest or not. Because of interest, whether your company is going into loss or not. So they find out how much times profit you are having as compared to interest. How is your profit covering your interest? Here it is covering 10 times. So it is a good ratio. This higher the ratio, it is better. There is nothing negative about it. If it is 100, it is more good. If it is 10, it is good. If it is 1, it is okay. But if it is less than 1, then because of interest, your company is going into loss. You should try to reduce your leverage as far as company is concerned. So how many times your profit is capable to cover your interest? See the name. Coverage ratio. And why we don't take earnings available to equity shareholders divided by interest? Can anyone explain me why we don't take numerator as earnings available to equity shareholders? Drashti?
Don't have any idea.
Any other student?
Interest will borrow interest already invested some earning equity for this.
Interest is already deducted, so you should not take that figure. Good, excellent. And try to concentrate what does it mean. If I am finding out how much I am capable to pay home loan installment, say, not interest but home loan installment. This is my personal thing, and home loan installment comes to 30,000 rupees for me. This is home loan installment. See, bank manager is asking me, how much is your salary? I say 50,000 rupees per month. So he calculates. He is earning 50,000 rupees, 30,000 rupees he can pay as home loan installment. And so what will be remaining is 20,000 per month, where he will be spending it for family. So bank will be ready to give me home loan because I am capable of paying home loan installment. This is the case. 50,000 per month and 30,000 per month is my home loan installment. Now concentrate. This figure, when you are comparing whether Jai sir is capable of paying this installment or not, this figure should be before paying installment. See, if branch manager or bank manager analyzes in this manner, Jai sir's salary is 50,000, home loan installment is 30,000, remaining is 20,000. How Jai sir will pay 30,000 as installment? This is not a correct evaluation. Why? If you want to know that whether I am capable of paying it or not, you should compare 30,000 with this figure, not 30,000 with 20,000. 20,000 is already after paying the installment. See earnings available to equity shareholders. It is already after paying the interest. You cannot compare that figure with how much amount or how much times your interest is covered by your profit. Are you getting it? So, interest coverage ratio will take a profit before interest and not profit after interest. And so only EBT is not used, so only EAT is not used, and what is used is EBIT. Alright. Number 2. It is preference dividend coverage ratio. Preference dividend coverage ratio. Alright. You want to know how your preference dividend is covered. So it will be in denominator, like here interest is in denominator. What should be in numerator? Can anyone help me out? What should be in numerator? Without seeing any documents, can you tell me? What should be the numerator? Which profit should be taken? EBIT, EBT, EAT, earnings available to equity shareholders. Vision? You should be taking PAT. Exactly. PAT or EAT. Profit after tax or earning after tax. Then only you can compare how your preference dividend is covered. Because preference dividend is paid after paying interest and after paying taxation. So you want to know whether you will be able to cover preference dividend or not. Which is the profit which should be used as earning after tax. Number 3, fixed charge cover. The fixed charge coverage ratio, we are not doing it. It is not important as far as this is concerned. Number 3 is debt service coverage ratio. Now please understand, even if debt service coverage ratio up till now is not asked at any point of time, this is the ratio used maximum in practical life. When you go to take a home loan, when you go to take a business loan, when you go to take any loan, the first thing which bank calculates is your DSCR. What is DSCR? They are similar to this. But try to concentrate. Instead of covering your interest or preference dividend, it is finding out how your cash flow is capable of covering this. Principal amount. Interest plus principal amount. Interest plus principal is nothing but installment. So how much profit? No. How much cash flow is generated from your business? So that whether you are able to cover your interest plus principal or no. This is installment, and understand, installment is not paid from profit. Interest is paid from profit. Installment is paid from cash flow. So in numerator, we will try to find out cash flow. How we will be finding out cash flow in numerator is net profit plus depreciation. Net profit and depreciation we have understood. So net profit plus depreciation will give you cash flow plus all non-cash expenditure. And concentrate. Interest. It is same interest as this. A small question. Anyone can tell me why interest is added over here? We already understood it somewhat. Abhishek?
Because it is a financial activity.
Then why it is added?
We are finding cash flow, so
Okay, you are finding out cash flow.
operating cash flow, so we have to add in interest because it is a financial activity.
Exactly. Your answer is absolutely correct. Try to concentrate. Also, we have understood this portion. You should find out cash flow before paying interest. If you are finding out that whether you are able to pay your principal plus interest or not, the cash flow should be before interest. Interest is debited to profit and loss account. It is already deducted while finding out net profit. So when you are comparing whether you will be capable of paying interest and principal or not, what should be done is you need to remove interest from the net profit. How to remove interest from net profit? In net profit, interest is already deducted. Now it will be added so that, see what I get. Cash flow before interest. Are you getting it? If I don't add interest, it is cash flow after paying interest, and it is not a good way to measure your whether you are capable of paying it or not. Debt. Debt means not only interest, also principal, whole debt. Service. Service is loan. Coverage ratio. Loan coverage ratio. Sorry. So this is nothing but third point, which is nothing but DSCR, debt service coverage ratio. This all three are coverage ratio will be evaluated by bank. This will be evaluated by preference shareholders. Other two will be evaluated by bank debenture holders when they are lending you money, when they are giving you loan. These are nothing but coverage ratio. Higher the coverage ratio, better is your chances that the money which you have lent to the company, you will be getting back as a bank. We are going to fifth type of ratio. They are turnover ratio. Explaining turnover ratio with example of stock turnover ratio, try to concentrate. I'm running a provision store. I'm not giving you formula, I'm explaining you where this is useful. If I'm running a provision store, I will have to do space management. What is space management is the items which are very regular, which are purchased in morning, sold in evening. That is, the turnover is fast. It is fast moving. ये आइटम चलती है अपने स्टोर पे. More fast moving item should keep it in provision store. Less or slow moving item I should not be keeping because they will require some space. And that space will be occupied for a long period of time. Fast moving items or stock, slow moving stock. Try to concentrate. I am talking about milk bags in provision store. How I will find out the turnover ratio is this. Cost of goods sold. Instead of cost of goods sold, let me take sales. Alright. What I need to find out? Stock of milk bags. Stock of milk bags. Are you getting it? What is sales or say per annum? Sales per annum is say 1 lakh rupees. What is the average stock? ₹1,000. It is 100 times. It is not even 100 times, I tell you. Let me take it. 10 rupees. Milk bag normally is not 10 rupees, but let me take it just for the sake of example. Why? At the end of the day, the stock practically will be zero of milk bags, right? Whatever is in morning, everything will be sold up till evening. There will be no stock of milk bags. But for the sake of explaining, let me take it 10. So it becomes 10,000 times. Try to concentrate. It moves 10,000 times in 1 year. That is 365 days. It moves 10,000 times in 365 days. I want to find out the turnover ratio in days. The turnover ratio in days. How I'll find out is one time will happen in how many days? It will be correct. Say this is 182 times. 182 will be 365 divided by 182, that is 2 days. Yes, it will be correct. One time will happen in how many days? So it is, this is 365 divided by 10,000. It is 365 divided by 10,000 will be 0.0365. See, this answer is correct, but let me take a good example whereby I can justify some numbers. Is it all right? Because the answer is not coming in days. Say, we are talking about chocolate. Cadbury chocolate. Lying in my provision store. What is sales? 1,82,000 rupees per annum. This is per annum. What is the stock of closing? That is the cost of closing stock lying in the godown at the end of the year or at the end of particular day. It is 1,000 rupees. Are you getting it? This is average stock. What is average stock means? What is your stock today? What is your stock tomorrow? What is your stock on third day? You will be burning out stock of all 365 days. Add it, divided by 365 is nothing but average stock. So what is my average stock of chocolate is 1,000 rupees. It is 182 times my chocolate moves 182 times in a year. In 365 days. See, what does this mean? Chocolate, I will purchase as a provision store wala. I will purchase a chocolate. I will sell a chocolate. This is one time. Again, I will purchase a chocolate. I will sell a chocolate. This is two times. In 1 year, this will happen how many times? 182 times. That's right. So, one time will happen in how many days? Let me take 364 days a year. One time will happen in 364 divided by 182. That is nothing but 2 days. So, my chocolate, if I purchase it today, on an average in 2 days it will be sold. It will not remain in my shop for 2, 3, 5 days. It will remain only for 2 days average. See, some of the chocolate might remain for 10 days. Some of the chocolate might be sold in 1 hour. But the average will come to 2 days. Sorry. I'm talking about some other thing, say oats or wheat packets or oats packet in my same provision store. Sales divided by closing stock of oats. I hope all of you know what are oats. Sales is 3,65,000 and closing stock of oats is 36,500. What is the answer? 10 times. 10 times. Let me find out in number of days. It happens 10 times in 365 days. One time will happen in how many days? It will be 365 divided by 10, that is 36.5 days. See, what does this mean? You purchase the oats as a provision store wala, you sell the oats. This is happening one time. Again you purchase oat, again you sell oat. This is second time. It will happen 10 times in 1 year. it will happen total. How many cycle it will rotate, how many turnover it will get in 1 year is 10 times. So it will happen every 36.5 days or every 37 days. So today you purchase the oat and keep it in your provision store. On an average, it is sold after 37 days. Can any student help me out? Which is a fast moving stock, which is a slow moving stock? This is a fast moving and this is slow moving. You don't have to deal with numbers every time. You can directly see this and find out the answer. You can even directly see this and find out the answer. But when it is times, you will have to understand more times in a year means it is fast moving. And when it is days, less number of days is fast moving. Agreed? So this is fast moving, slow moving, and this is the ultimate reason why you find out turnover ratios. To see whether a particular thing is fast moving or slow moving. Is it alright? We are going to turnover ratio. The first turnover ratio is raw material turnover ratio. So this will also show the same thing. Whether your raw material after purchasing is in your godown for a long period of time or for a short period of time. Raw material turnover ratio, for what you are finding out turnover, raw material, so raw material stock. I'll write down average stock of raw material. See, when you are comparing the stock, you compare it with sales. Whenever you are finding out turnover of raw material, it should be raw material consumed. Numerator cannot be sales if you are comparing raw material. Number 2 will be WIP turnover ratio. Average stock of WIP. Numerator, production cost. Alright, I'm just explaining it. Concentrate. For one of the stocks, say A, WIP turnover ratio was 10 times. For another B, WIP turnover ratio was 20 times. I told you this is fast moving as compared to this. It is slow. What does this mean? Work in progress turnover ratio is fast moving. What does it mean? Any student? Darshita?
It is converted into finished goods fast.
This is the case. See, raw material is purchased and then used in production. It becomes WIP. For a period of time, say 15 days, 20 days, it remains WIP. If you go to car showroom, car factory, manufacturing factory, there will be unfinished car lying in the godown. That are nothing but WIP. What does fast moving shows? It is fast converted from raw material to finished goods. What does slow shows? It is slowly converted from raw material to finished goods. And this is what WIP turnover ratio will show. Number 3. Finished goods turnover ratio. We have done it in form of example, right? These are finished goods turnover ratio. What you will be taking? Average stock of finished goods. What you should take in numerator? We have taken sales, but what you should take is COGS, cost of goods sold. But concentrate, if COGS is not available, you may take sales. So, whenever you are talking about turnover ratio, you should exclude profit. But if say as an academician or as a student, you are not having any way to find out COGS from sales. What is COGS from sales? Sales minus GP is COGS. Or opening stock plus purchase minus closing stock is COGS. So instead of COGS, you may take sales. In our example where we have understood, we have taken sales. This is finished goods turnover ratio. If you want to find out same answer in days, the answer will be in times. If you want to find out same answer in days, turnover ratio, it will be turnover ratio, no, 365 divided by turnover ratio in terms of time. So say this. 365 divided by 10. 364 divided by 182. I will be getting answer in days. The answer will be in days. Sir, if you want to find it out in months, it is 12 divided by turnover ratio in times. Is it all right? You will be getting answer in months. Is it all right? Yes. Higher times, fast moving. Lower days, fast moving. Is it all right? That should be understood when you are interpreting it. The point is, at your intermediate level, more interpretation is not asked. What is asked are questions. Is it all right? So only understanding is important, but to remember it, believe me, this becomes extremely easy. See, turnover ratio. What turnover ratio? Raw material. In denominator, you should write down average stock of raw material. Number 4. Debtors turnover ratio. Debtors turnover ratio. For what you are finding out turnover debtors, then average debtors will be your denominator. Average debtors will be your denominator. What should be numerator? Sales. No, it should be credit sales. Alright? See, it comes 12 times. See, I'll explain you first in a difficult way, then I'll summarize it and it will be absolutely clear. You manufacture the goods, sell the goods on credit, and then the money is recovered one time. Again, you sell the goods on credit, again the money is recovered 2 times. This happens 12 times in a year. This happens 12 times in a year. Let me convert it into months. Debtors turnover ratio in months. It will be 12 divided by turnover ratio in times. 12 times will be 1 month. Say this is nothing but you allow 1 month to debtors. You allow 1 month to debtors. This is nothing but debtors turnover ratio. In number of months, it is as good as debtors period. It is as good as debtors period. If you remember, insurance in accountancy, see how we have found out, say credit sales was 1,20,000. Average debtors was 10,000. It came 12 times. Then we did 12 divided by this. So ultimately, 1 month, how I have got the answer? 12 divided by 1,20,000 divided by 10,000. So it is 12 multiplied by 10,000 divided by 1,20,000. That's it. 1 month or 1. I have got by this ratio, the answer will be 1. Start it. Now try to concentrate on reversing the side. 1 divided by 12 multiplied by 1,20,000 is equal to 10,000. Sorry. This is very known formula. Concentrate. Credit period divided by 12 if the answer is in months, multiplied by credit sales will be nothing but answer of debtors. This we have done n numbers of times in accountancy. Credit sales multiplied by, if the debtors are 2 months, into 2 divided by 12, I will be getting answer of debtors. At that time we have just not understood the concept of debtors turnover ratio. Again, if the debtors turnover ratio is 24 times, it is faster. What is faster? Recovery of money from debtors are faster as compared to the ratio of 12. Sorry. Debtors turnover ratio. Number 5. Creditors turnover ratio. I will not explain you this, but I will be just understanding the formula. Average creditors. In numerator, it will be credit purchase. Sixth, working capital turnover ratio. What should be in the denominator? Net working capital. So this formula we have forgotten when we did liquidity ratio. We understood current ratio, but we forgot to write down net working capital is current asset minus current liability. This is also one of the ratio. It is not actually a ratio, but it is a figure. Net working capital is current asset minus current liability. Current asset is only working capital. Net working capital is asset minus liability. Turnover ratio, I am finding it out for working capital. So denominator will be net working capital. What will be in numerator will be sales. So this will also show you how your working capital is fast or your working capital requirement is slow. Everything teaches you the same thing. Number 7. Fixed asset turnover ratio. Normally this will be less than 1. When we will be going to formula at the time of sum, I will explain you even the concept. What does it mean? But right now we know how to derive turnover formulas. Fixed asset turnover ratio. So fixed asset will be in denominator. Turnover will be in numerator. Total capital turnover ratio. I want to find out capital turnover ratio, denominator capital employed, numerator turnover, that is nothing but sales. This is how you find out turnover ratio, and each turnover ratio says you the same thing, whether they are fast moving or whether they are slow moving. This were nothing but turnover ratio. Most important is debtors turnover ratio and stock turnover ratio. Which will be used n numbers of times in questions. At that time, we will be also again revising one more time what is turnover ratio and what does actually it means. But it is very easy to remember the turnover ratios, right? In denominator, if you are finding out raw material turnover ratio, then in denominator it will be raw material. In numerator it will be raw material cost. If you are finding out stock turnover ratio, stock will be in denominator, in numerator it will be credit sales. Stock. We are going to next, that is overall or other ratios. What are other ratios? Try to concentrate. The other ratios cannot be categorized as liquidity, profitability, and they are technically current ratios. Return on investment. R. We have understood if R is greater than KD. If R is less than KD, R is greater than KD, there is a favorable leverage. R is less than KD, it is unfavorable leverage. What is R? EBIT upon capital employed. We have understood at the when we were learning capital structure decision. What is my operating profit? 7 lakh. What is my total capital employed? 10 lakhs. This is 1 year. Capital employed is 10 lakhs and profit is, operating profit is 1 lakh. So you are earning 10% on the total amount invested in your firm. And it is that same or return on investment. Return on equity. See now, you want not your return on total capital employed. You want return on equity. Then return on equity will not be EBIT. Return on equity will be earnings available to equity shareholders. EBIT is not available only to equity shareholders. EBIT is available to equity shareholders, preference shareholders, as well as debenture holders. So you cannot compare equity over here. See, when I was finding out return on my total capital employed, equity plus debt, I was taking EBIT. But when I am finding out return on equity, it is equity earnings available to equity shareholders divided by equity. Is correct. You also know this? Say return on equity is say 10%. Or equity or value of equity will be is equal to earnings available to equity shareholders divided by return on equity or KE. Again, that net operating income formula of capital structure. Value of equity is equal to earnings available to equity shareholders divided by KE. This will be nothing but, yes? Yes, Kishan?
You say equity also include preference share.
Yes.
Yesterday you have said.
Yes.
So they include or not?
Yes. So practically, this I should write down as a return on equity shareholders. Correct. Here it will be only equity shareholders. See, whenever we do a write down, normally any formula we assume there is no preferences. But if I really want to find out return on equity, equity, as you told, includes preferences. Then in denominator, it will be equity. Here it will be equity shareholders fund. But here it will be equity. Equity includes preference shares, agreed. Can you tell me who has asked the question?
Sir.
Yes, Kishan. Can you tell me what should be numerator? Which profit is available to equity share? Exactly. Then in numerator, you should write down EA. Sorry. So, but if there is no preference dividend, ultimately earnings available to equity shareholders and EAT will be same. But if there is preference dividend, you need to understand whether you are finding out of return of equity shareholders fund, that is equity plus reserves, or you are finding out return on equity. If it is equity, in numerator you should take EAT. Sorry. So these are both concepts which you need to understand. Return on assets. It is EAT divided by average assets or total assets. EAT normally is net profit, right? So if net profit is available, you can take net profit. I should not write down in bracket, otherwise it will show that I'm multiplying it. But this nothing but net profit. You can use earning after tax. It is practically deducting all expenditure except that charge. Correct. So it is EAT divided by total assets. EPS. It is earnings available to equity shareholders divided by. This I will not be going into detail. We have done it n numbers of times. EPS. Dividend per share. Is a total dividend divided by number of shares. Is nothing but dividend per share. Again, this is not much relevant. Alright. Dividend payout ratio. See, this will be useful at n numbers of places, in accountancy also, in finance also. Dividend payout ratio, dividend ratio, and dividend yield ratio. There is difference. What is dividend payout ratio? How much dividend you are declaring per share or total dividend divided by how much is your earning per share. Or you can even write down total dividend divided by total earnings. It is one and the same. Whether you take per share or whether you take total, ultimately they are divided, the answer is going to remain same. So what is dividend payout ratio? If you are earning 10 rupees and if you are paying 8 rupees, 80% will be dividend payout ratio. It is compared with earnings. See, what is dividend ratio? Company has declared 10% dividend. Then this is dividend ratio. What is it? Dividend per share upon face value per share. Dividend is always paid on face value. So it is showing that if face value is 100, dividend declared is 10 rupees. This is compared with face value and not with EPS. Or you can also write down total dividend divided by total face value. The answer will be same. I hope mathematically you can understand, answer will be same. What is dividend yield ratio? Again, it is comparing dividend per share, but with market price per share. See, Reliance has declared 10 rupees dividend and its face value is 10. This will be 100%. So they will keep big holdings that Reliance has declared 100% dividend, but that 100% is on face value. Right now, market price of Reliance is say 2,000 rupees. It is more than 2,000, but let us assume 1,000 rupees. How much dividend they have declared? 10 rupees. It is not even 10%. It is 1% on market price. See, I am a new investor. I have entered or I have purchased Reliance as 1,000 rupees. 10 rupees dividend is how much percentage return? 1% return. Then as an investor, I should find out dividend yield ratio. It is compared with market price. Is it absolutely clear? Dividend payout ratio is written, it is compared with earnings. Dividend ratio is compared with face value. And dividend yield ratio is compared with market price per share. That's all right. So, any place, auditing, accountancy, finance, whenever you see this ratio, think which ratio is written, whether it is dividend payout, dividend ratio, or dividend yield ratio. PE ratio. We have understood it in capital structure. It is comparing MPS divided by EPS. It is showing the relationship between your earnings and how much multiple is your market price as compared to your earnings. Yes. This is end of other ratios. Return on investment, return on equity or return on equity shareholders fund, return on assets, EPS, all three ratios of dividend and PE ratio, which is nothing but MPS divided by EPS. What is expected from you tomorrow? What is expected is you mug up, understand, try to interpret. I'm not saying write a full essay of interpretation of all the ratios, but try to understand it logically. What does it mean? So that if someone asks you whether it is good or bad, you can answer it by thinking somewhat, you can answer it whether it is good or bad. Don't attend tomorrow's lecture, next lecture, without learning ratios. Believe me, it will be a useless exercise. You will not understand anything. You will not be able to do anything. Prepare a chart of all 6 categories or 6 pages in your book. Write down once in your own handwriting. Mug up all the ratios. We will be easily able to solve the questions. It is then just mathematics. If you are knowing ratio, it is just mathematics and logic by which we can solve the questions.